Okay, so now let's go on to the risk-sharing model of DeFi. In traditional economics or in traditional insurance, you pretty much have two parties. The first party is the principal, like you and me, we buy insurance. Second party is the agent, which is the insurance companies, and they will assess your risk. In DeFi, we are looking at distributed. We're looking at decentralization. So we have three different parties. The first one is, again, people like you and me, the buyer. So the insurance cover buyer. So we buy the insurance cover and because we want to be covered, right? So it's almost like the user. Then we have the risk assessor. The risk assessor will be people who assess the risk. Is this smart contract risky enough? Or this smart contract is actually pretty safe and I'm willing to put my money in there to say that this is safe. You have your claim assessor. Claim assessor is where there's something happened, like there's a fault in the bug, and the claim assessor comes in to see that, okay, this person deserves a payout or this person doesn't deserve a payout. Simple as that. So you have three parties. Now, these three parties will be working hand in hand to be distributing the risk available in this entire system. So let's see how. So once again, we can only do the internal technical risk, right? Which is the smart contract code. So this will be stuff like a bug happens and then you need to cover that insurance of like that bug. The insurance covers that bug of the smart contract code. So for example, we take this example of smart contract code, and the cover is where the buyer will buy an insurance cover. So let's say the buyer wants to insure 500 DAI. And because DAI is quite a safe system, so I just have to pay insurance of, let's say, 2 DAI. So I will pay the insurance, it goes into the pool. And if nothing happens, I just give my 2 DAI and then continue on with life. If something happens, I file for a claim. The claim will assess, okay, this smart contract, is there a problem? Is there a bug? If there's no bug, sorry, you can't get anything. If there's a bug, we could prove that there is a bug, then your claim passes, 500 DAI is returned to you. All you lost is that 2 DAI to buy insurance, but you get your 500 DAI back. And that's it. Good to go. Next. So that's the perspective of the buyer, right? Then you have the risk assessor. Risk assessor are people who decide if this smart contract is risky enough or not. So let's say it's a Lisa smart contract token or the Lisa smart contract. And someone reads it and say that, okay, you know what? I think this is safe. I will assess it as a low risk. So I'm willing to stake my NXM token. So NXM is the internal token of Nexus Mutual. I'm willing to stake NXM tokens into this pool. And that means I put my money where my mouth is. If I say that this is low risk, I put my NXM token here and then you allow for that period to happen. Let's say the contract lasts for 80 days. 80 days happen and there's nothing happen, like no bugs and anything. I get back my NXM tokens, and for the premium paid, I get part of the premium paid as well. So just now a person paid 2 DAI into it, right? So let's say there's 2 DAI plus my NXM token. So I get my NXM token back and I get some part of the DAI back. If something happens, then I will lose my money because the money that I put in there, it will be used to be compensating the claim buyer. So that, you see, the person will get back 500 DAI, but the person only puts 2 DAI in there. So where does the 498 DAI comes from? So it comes from this risk assessor and the NXM token. So that's for the risk assessor. Now, what about the claim assessor? The claim assessor comes in when there's a claim to be assessed. That means there's a bug in the code and someone needs to come in to say, yes, there's a bug in the code, or no, there's no bug in the code. So again, to be an assessor, you have to stake your NXM tokens to evaluate. So if let's say I say, okay, I'm expert in bug fixing. So I will take my NXM token, I will stake it there, and let me evaluate the system. And when I evaluate, I realize that, and I get to choose. Yes, that this person needs a payout, or no, this person doesn't need a payout. Based on that, then everyone will be voting. And the votes will be, weighted and whatever. There's three outcomes. The first outcome is that you are part of the majority. So I think it's a 70% majority. So if 70% of people say that yes, this person needs a payout, then okay, you get back your tokens, and then the person will be getting a payout, the cover buyer. If you're part of the minority, and you're being truthful anyway, but you're part of the minority, your NXM tokens will be locked up for a long time, or a longer time. So it's kind of like a punishment, but you don't lose your tokens. You just lose the opportunity cost of using their tokens, but you do not lose your tokens and the value. However, if they found out that you lie, then your tokens will be burnt, confiscated, and deleted from you. So then it gives someone a disincentive to want to lie. So you have your different incentives and disincentives in all these 3 different kind of participant roles, which is very interesting.